Co-living is one of the highest cash flow strategies in residential real estate today. When executed correctly, it can outperform traditional single-family rentals and even small multifamily properties by a wide margin on a monthly basis. But here's what most investors don't realize. Many are quietly destroying their profits by making a few simple, avoidable mistakes that drain thousands of dollars from their bottom line every single year without them even noticing. In this video, I'm breaking down 3 critical mistakes that kill co-living cash flow, and more importantly, how disciplined, experienced investors avoid them completely. If you're considering co-living as an investment strategy, or you already rent rooms and want to maximize returns, this information could literally save you thousands of dollars per year. These are not theoretical mistakes pulled from a textbook. These are real, documented issues that cost investors hundreds to thousands of dollars per month on a single property. I've personally seen these mistakes destroy what should have been incredibly profitable deals. Let's get into it. The most common mistake in co-living is underpricing rooms. Investors often base pricing on Craigslist ads, unfurnished roommate listings, outdated rental comps, or apartment rents divided by bedrooms. Then they discount even further because they fear vacancy. That comparison is completely wrong. Co-living does not compete with basic roommate housing. It competes with furnished apartments, corporate housing, extended stay hotels, monthly Airbnbs, and serviced accommodations. Those options cost significantly more because they provide flexibility, convenience, and a turnkey living experience. When investors compare to the wrong market, they often leave $150 to $300 per room per month on the table. In a 5-bedroom home, that's up to $900 per month, or over $10,000 per year in lost profit. Smart investors price based on value delivered: furnished rooms, utilities included, flexible terms, vetted housemates, and move-in-ready convenience. Higher pricing attracts more stable residents and often reduces turnover. Most investors budget for obvious expenses like mortgages, taxes, utilities, insurance, and maintenance. What they forget is turnover, and that's where profits quietly disappear. Turnover includes vacancy days, professional cleaning, repairs, repainting, item replacement, advertising, and management time. When calculated correctly, turnover often costs $400 to $600 per month per property. If your projections assume full occupancy, zero vacancy, and no reset costs, your numbers are already wrong. Professional investors budget turnover monthly, price to absorb movement, and build reserves. Turnover isn't the enemy. Unplanned turnover is. Co-living is not passive income. It is an operating business inside a real estate asset. Without clear rules, strong screening, consistent enforcement, conflict resolution, and hospitality-level standards, investors experience high turnover, property damage, burnout, and negative reviews. Successful operators treat residents like customers and run documented systems. That mindset is what turns co-living into business-level income instead of basic rent. Co-living can be incredibly powerful when operated correctly, but when approached casually, it becomes stressful, time-consuming, and far less profitable than advertised. The difference between success and failure is rarely the property itself. It is almost always pricing discipline, operational systems, and the willingness to treat the model like a real business. If you approach co-living with the right expectations, strong processes, and realistic financial assumptions, it can become one of the most resilient income strategies in residential real estate. But if you ignore these fundamentals, the cash flow you expect will never materialize. Learn the model before you scale it. Build systems before you buy more properties. Always price based on value, not fear. Watch our other videos for deeper breakdowns on underwriting co-living deals, setting up house rules, screening residents, and building repeatable systems that protect both your property and your cash flow over the long term. If you found this breakdown helpful, share it with another investor who is considering room rentals or already struggling with co-living performance. Most mistakes in this space are completely avoidable once you understand where profits are actually made and lost. Education and preparation are what separate sustainable operators from investors who burn out early. This is not about working harder. It is about working smarter, pricing confidently, and operating with intention. When you do that, co-living stops being chaotic and starts becoming predictable, scalable, and highly profitable over time. To help you avoid these mistakes, we created a free Co-Living Investor Toolkit. You'll receive a deal analyzer, buying checklist, shared housing models report, access to our private investor network, and updates on new educational content. Email subscribers also receive an exclusive 10% discount on the Living Smith Co-Living Program by Grant Shipman. Sign up below, like the video, subscribe for more strategies, and comment with your co-living experience. This channel exists to give investors real warnings, not hype.